Hello, my econ students. My name is Mr. Jeter. Today we're going to take a look at the Federal Reserve System. Now, in previous weeks, we look at different types of markets, different types of economic systems, and we talk a little bit how the government can often influence market systems, sometimes for the good, sometimes unexpectedly for the bad. But now we're going to take a look at the Federal Reserve System. It was set in place to purposely affect our economic systems. So let's take a look at that. Without further ado, I'm going to share my screen with you. All right, here we are, the Federal Reserve System. Again, my name is Mr. Jeter. All right, the Federal Reserve System. Our goals: students will understand the Federal Reserve System, the function of the Federal Reserve, and its effects on the economy. Our TEKs are E13, A, B, and C. Explain the structure of the Federal Reserve System, analyze the basic tools used to implement U.S. monetary policy, and how those actions affect the nation's money supply. Students will be able to define what is an economic indicator and what conditions they reflect, explain the three functions of the Federal Reserve System. 3, explain how the Federal Reserve uses monetary policy to affect overall economic conditions in the economy. All right, markets and governments in modern economy. Okay. In the last section, we talked about markets and how the government often intervenes by either giving subsidies or granting contracts to portions of the commercial sector. Since the Great Depression of the 1920s, the government has often intervened in commercial markets if things are not going well economically. Sometimes this is done for the good, sometimes unintentionally, bad things often occur. Okay. One of the main tools the government uses to affect markets and the economy in the U.S. is through the Federal Reserve System, or the Fed. The Federal Reserve System is the central banking system of the United States of America. The key goal of the Federal Reserve System is to provide stability to the economy and achieve maximum sustainable economic growth, price stability, and low unemployment. The Fed was created on December 23, 1913, with the enactment of the Federal Reserve Act, after a series of financial panics led to the desire for federal control of the monetary system in order to alleviate financial crises. In 1977, Congress gave the Fed the added mandate to also, 1, influence maximum employment, and 2, stabilize prices. This is called the dual mandate. The three functions of the Federal Reserve System are to regulate and supervise banks, operate the payment systems, and establish and implement monetary policy. To accomplish these goals, the Fed uses control of the national banking system through its 12 Federal Reserve banks and their 24 branches located in Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco, operating its monetary policy. Now you may ask, what is monetary policy? Well, I'm glad you asked. Monetary policy is the management of the amount of money available for economic transactions, which affects national income, price levels, and employment. As reviewing economic indicators such as inflation, gross domestic product, GDP, and labor market data to determine whether the economy seems headed for recession or inflation, Fed policymakers have 3 tools at their disposal to affect the money supply and make the business cycles, upturns and downturns, less severe. 1, carrying out open market operations. 2, changing the reserve requirement. And 3, changing the discount rate. First, open market operations, or OMO. This is when the Federal Reserve buys or sells primarily U.S. Treasury securities on the open market in order to regulate the supply of money that is on reserve in U.S. banks and therefore available to loan out to businesses and consumers. To increase the money supply, the Fed will purchase bonds. To reduce the money supply, the Fed will sell the bonds. The other thing they can do is change the reserve requirement. When the Federal Reserve decreases the reserve ratio, it lowers the amount of cash that banks are required to hold in reserves, allowing them to make more loans to consumers and businesses. This increases the nation's money supply and expands the economy. Okay, this also can be done the opposite way. Okay, they can ask that the Federal Reserve increase as well to have the opposite effect. And finally, changing the discount rate. Okay, a decrease in the discount rate makes it cheaper for commercial banks to borrow money, which results in an increase in available credit and lending activity throughout the economy. Again, they can increase or decrease it. The Fed tracks trends in many areas of economic activity to see if there are signals pointing to a recession or an inflation, or whether the risk of recession and inflation are balanced. The top three economic indicators are the Consumer Price Index, which tracks inflation or deflation, Gross Domestic Product, or GDP, which is the monetary value of all finished goods and services in a country for a given year, and labor market data, how many people are unemployed or employed. As of October 7, 2020, there was $1.99 trillion worth of Federal Reserve notes in circulation, and the U.S. has a net worth of $123.8 trillion. This includes their assets of $269.6 trillion and the debt, which is constantly changing, but as of this presentation, $145.8 trillion. In conclusion, the Federal Reserve, or the Fed, does three things. One, they regulate and supervise. The Federal Reserve System has supervisory and regulatory authority over a wide range of financial institutions and activities. It works with other federal and state authorities to ensure safety and soundness of our financial institutions, stability in financial markets, and fair and equitable treatment of consumers in their financial transactions. Two, it operates the nation's payment systems. 12 Federal Reserve banks provide banking services to institutions, maintain reserve and clearing accounts, including collecting checks, electronically transferring funds, and storing, distributing, receiving, and processing currency and coin. The Fed maintains the Treasury Department's account, pays Treasury checks, and issue, transfer, and redeem U.S. government securities. And number three, the Fed establish and implement monetary policy. Using the tools of monetary policy, the Federal Reserve can affect the volume of money and credit available in the economy and the price of credit, interest rates. In this way, the Federal Reserve can influence the general levels of prices, employment, and output for either a recession or the opposite. Or there you go. We just talked about the Federal Reserve System. I have a ticket out the door for you and an actual exercise for you to go through. If you would, go ahead and take a look at your warm-up and your ticket out the door data and go ahead and answer those questions.